Welcome to this lecture on internal controls in banking and financial services. In this session, we'll explore how internal control systems function within banks and financial institutions to protect assets, ensure compliance, and maintain trust in the financial system. The banking and financial services sector operates in one of the most highly regulated and risk-sensitive environments in the world. Because banks handle large volumes of transactions and customer assets, internal controls are essential for maintaining financial integrity, preventing fraud, and complying with strict regulatory requirements. Let's begin by understanding the objectives of internal controls in banking. 1. Safeguard deposits and assets. 2. Ensure the accuracy of financial records. 3. Promote compliance with laws and regulations. 4. Prevent and detect fraud and operational errors. 5. Support sound risk management and governance. The internal control framework in banking aligns closely with the COSO framework and regulatory guidelines from institutions such as the Basel Committee on Banking Supervision, BIS. Banks must implement robust controls across all areas, from lending and treasury to compliance and information technology. Let's examine the 5 key components of internal control as applied to financial institutions. 1. Control environment. This forms the foundation. Tone at the top is critical. Boards of directors and senior management must demonstrate integrity, ethical behavior, and accountability. Clear policies, performance expectations, and governance structures reinforce this foundation. Risk assessment. Banks face a wide range of risks, including credit risk, market risk, operational risk, liquidity risk, and compliance risk. Risk assessments identify these exposures, evaluate their impact, and prioritize control measures. For example, credit risk assessments ensure that loan portfolios are diversified and that borrowers meet defined criteria. 3. Control activities. These are the specific procedures and mechanisms that mitigate risk. Dual authorization for high-value transactions. Segregation of duties between trading, settlement, and accounting functions. Reconciliations between general ledger and subledger accounts. Limits on cash handling and investment exposures. Automated transaction monitoring to detect suspicious activity. Information and communication. Banks rely on timely and accurate information for decision-making. Reporting systems must provide transparent data on liquidity, capital adequacy, and risk exposures. Communication channels ensure that policies, regulatory updates, and risk alerts are shared promptly across departments. 5. Monitoring activities. Ongoing monitoring through internal audit, compliance testing, and risk management functions ensures that controls remain effective. Regular reviews identify weaknesses and trigger remediation actions. Regulatory compliance plays a major role in banking internal controls. Financial institutions must adhere to laws such as the Bank Secrecy Act, BSA, anti-money laundering, AML regulations, Know Your Customer, KYC requirements, and data protection laws like GDPR. These frameworks mandate specific control processes, including transaction monitoring, customer verification, and suspicious activity reporting. Let's discuss examples of key internal controls in banking. KYC controls, procedures for verifying the identity and background of customers to prevent money laundering and terrorism financing. Transaction monitoring systems, automated systems that flag unusual or high-risk transactions for investigation. Reconciliation control, regular reconciliation between bank records, external statements, and customer accounts to detect discrepancies. Limit controls, credit and trading limits set to prevent overexposure and maintain risk discipline. Access controls, restricting system access to authorized users and implementing multi-factor authentication. Audit trails, maintaining detailed logs of all system activities for accountability and forensic review. A strong 3 lines of defense model supports these controls. 1. Business units own and manage risks. 2. Risk and compliance functions monitor and guide risk management. 3. Internal audit provides independent assurance to the board and regulators. Technology plays a critical role in banking controls. Core banking systems, ERP platforms, and advanced analytics enable real-time monitoring and reporting. Artificial intelligence and machine learning now enhance fraud detection by identifying abnormal transaction patterns and predicting emerging risks. Let's look at a real-world example. A major global bank implemented an AI-based transaction monitoring system that analyzed millions of transactions daily to detect unusual behavior. The system identified several potential fraud cases that traditional rule-based controls had missed. This demonstrates how technology-driven internal controls can significantly strengthen risk management. However, challenges remain. Cybersecurity threats, complex financial instruments, and evolving regulations require banks to continuously update their control frameworks. Regular training, risk culture reinforcement, and collaboration between business, compliance, and IT teams are essential for sustaining effectiveness. To summarize, internal controls in banking and financial services protect customer assets, ensure compliance, and uphold the integrity of the financial system. By integrating governance, technology, and regulatory requirements, banks can manage risks proactively and build resilience in an ever-changing environment. In our next lecture, we'll explore internal controls in the public sector, where we'll see how governments and public agencies apply control principles to ensure accountability and transparency in managing public resources. Thank you for joining me in this session on internal controls in banking and financial services.